Let me know when you're ready.
Just 1 second. And
Morning,
okay,
Jim.
Dennis, take it away.
Okay, good morning, everyone, and welcome to the Kushner Report for February 2023. At the conclusion of the presentation this morning, you'll have an opportunity to participate in our question and answer session. I have a lot of data today. We may run a little bit over, but I think it's a lot of interesting things going on right now. So what I'd like to do now is take a quick look at our agenda for this morning. That was me in an earlier age. So we're going to talk about the key economic indicators, the global economy, the domestic economy, mergers and acquisition, and what's ahead in actually other significant economic news, and then what's ahead in 2023. And this morning, I thought we'd take a look at the manufacturing coming back to the United States. I'm going to talk briefly as an overview for the commercial and residential real estate market, and then we're going to give you kind of a snippet about the recession status for 2023. So that's kind of what we're going to cover today, and then we'll have our Q&A after the session. So there's a movement ahead right now where we're talking about the United States now in all vertical markets is moving to a point where they're bringing back manufacturing to the United States. And really the lack of manufacturing competitiveness in the US leaves us really vulnerable on shortages of critical goods during times of geopolitical disruption and global competition. And the strategies for the United States employs bringing back manufacturing along with innovative practices will be key to ensuring our national security. And you know what's taken place during the pandemic, getting certain things, we just couldn't get them. And we can't allow that to happen in the future. The continued supply chain disruptions during COVID-19 really brought a lot of attention on the light of independent nations, or when it comes to manufacturing, and the inability of the United States to produce such needed goods such as test kits and personal protective equipment during the pandemic revealed our real vulnerabilities as a nation. Now, bringing back manufacturing mandates the fixing of the supply chain disruptions, which will benefit our nation and our national security. The semiconductor problem is a monumental task and must be fixed within our country to provide US needed capability and independence and less reliance on foreign manufacturing. And the serious disruptions of the computer chip industry has really hindered American operations across all vertical markets and has negatively affected the economy too. And if you look at the vertical segments, we can no longer rely on Taiwan for manufacturing our chips. At one time, Taiwan was responsible for manufacturing 54% of the chips in the world, and we can't allow that to happen again, where we have to have that level of reliance. As we enter 2023, the development of building of US manufacturing semiconducting plants will take time over the next few years. And I talked about it last year where we've had 6 or 7 or as many as 10 plants are now being built all over the United States, in Arizona, Ohio, etc. And hopefully in the not too distant future, a lot of those plants will come online and will be able to be self-sufficient in developing and making chips for all of their industries, such as the automobile industry, etc. They've all suffered over the last 3 years. New and innovative techniques and processes and business policies, coupled with extensive training, really will improve our security and safety in the improvement of the domestic economy, and thus removing the threats of supply chain shortages and lost corporate revenue. We can no longer outsource and mortgage our future. If you go back to the 70s, where companies like GE and everybody else began to outsource everything because it was cheaper, we lost that capability to build and supply our own needs. And then we must basically find new workers and train them for advanced manufacturing to strengthen the sector and allow us to rely on technology. And we've lacked that training and development over the last several years. If we look at the outlook for 2023, basically, accelerated growth amid anticipated challenges. So despite the headwinds we're seeing right now today in February, labor shortages and uncertain economic environment, the manufacturing industry, keep this in mind, continues to surpass expectations of previous years. It's still very strong in this country. The manufacturing has really demonstrated continued strength in 2022 while we're building the momentum it gained emerging out of pandemic. And basically, surpassing expectations over the last 2 years. You know, the manufacturing industry really relies on 5 critical trends that are going to take place over the next few years. Number one of criticality here is technology. Manufacturers have increased their digital equipment and their digital technology over the past few years and accelerated the adoption of emerging technologies. And you see that in different areas of the United States. Talent is also critical. Organizations must implement a broad range of talent management strategies to reduce voluntary exits and addressing the tight labor market and workforce churn amid shifting talent models that is expected to remain at the top priority for the United States in 2023. Supply chain, again, we go back to this again. Surveys by executives again persist that the shortage of critical materials and the ongoing supply chain disruptions really present the biggest uncertainty for this industry. The smart factory, well, manufacturers will likely continue to progress toward a smart factory transformations, really, as initiatives have really developed for the future of competition on a global basis. And then we have sustainability. That's the fast evolving environment, social and governance landscape may requiring monitoring the 2023 manufacturing segment of the marketplace. So that's what's taking place in manufacturing. It's all good. Keep in mind, a lot of the drugs that were demanded that we needed for across the country, we were having to bring them in from other countries. And we can't rely on that anymore. We've got to be self-contained in that area. Now I want to take a little bit of a look here at what I would call the commercial real estate market. As you know, it's going to be a challenging year in 2023 and possibly even into 2024. High interest rates and a recession will make 2023 a challenging year for the commercial real estate market. Through inflation disease in 2022, there's still many segments that are over 7%. The recession will not be particularly deep, as many economists believe. Corporate finances are in good shape and employers will shun excessive layoffs to avoid losing employees in the tight market and key for skilled labor. The factors suggest a moderate downturn and expectations are we should not see unemployment reaching 6%. Keep that in mind, that's critical. And the economic headwinds, well, the pace of change will not ease. The growth of the digital economy will continue to affect real estate demand throughout the United States, and you'll see different kinds of hybrid processes taking place, which I'll address in a couple of minutes. Now let's take a look at a couple of things. So the data centers and industrial real estate are most resilient sectors at this time. As e-commerce increases, we're finding that the need for warehouses and industrial space continues to be a demand across the country. And e-commerce, if you will, even though it represents 20% of retail sales, go back 2 or 3 years ago, Jim Carr, when it was probably about 4 or 5%, and it continues to escalate as things go on. People are buying rapidly online for various things, including food and everything else, which increases the demand and the need for e-commerce capabilities and technologies. The resurgent retail sector is just reaping benefits now of a long period of change, which is really attracting key investment interests. So for example, if you look at some of the malls, you've seen where the stellar companies like Sears and JCPenney's and Macy's are moving out. They're being replaced by a lot of high-skilled restaurants, such as in San Diego, and other things like a Postal Annex. So spaces are starting to come back now, and there's new retailers also taking space in these areas and getting better deals on real estate with lower leases, low rental prices. If we look at the future of the office building market, Jeff and I were talking this morning about this. The important note here is a regional basis. And we've seen that vacancy rates have dipped below the pre-pandemic level. Office space sector is very interesting. Here's a quick overview. The office space sector will undergo a restructuring in 2023. There are 3 key areas that we want to evaluate. Number one, some employees will return full-time to the office, such as Gene company here in San Diego. Some employees will continue to work remotely, and then again, we'll have a hybrid, and that is we'll have some people be working maybe 1 to 2 to 3 days a week in the office or working at home for 1 to 2 days a week. So you're going to see that kind of a combination going forward. And what that means is over time, you're going to see what's going to take place. For example, what's taking place right now is a lot of companies that have space are either leaving the space unannounced or moving out, closing out, and leaving the building vacant and trying to sublease these buildings. A perfect example is San Francisco, and I'll talk about that later in the presentation. And then you have situations where if they can't renegotiate lower rates, when the lease terms come up, and as long as it's not a 99-year lease, they're gonna either say, look, either you lower the rates or I'm moving out, and they'll find a new place to go. So that's what's going to take place. Experts expect, and this is important for Kathy, that the outlook for commercial real estate in 2023 will pick up in the second half of this year as the economy begins to stabilize and pricing begins to change. The top trends in commercial real estate right now investing, there's a lot of money of uninvested capital sitting on the sidelines. It remains there for the time. Investors are really shaking their focus now to debt strategies and value-added opportunity plays. So you'll see some buildings that were highly priced with high values are coming down, and what's going to happen, you're going to see people that have money are going to swoop in and take those buildings over and decide what they're going to do with them later. Most assets around the country in the commercial marketplace are going pretty well. Now let's take just kind of an overview of the real estate market. So, the housing market projections for 2023, when will home prices become more affordable? That's the $64 question. Skyrocketing interest rates, mostly in 2022, put much needed pressure on the housing market, as you've seen, after home prices really hit record highs across the nation over the last 2 to 3 years. But the nation's overall housing market remains limited, as those who purchased homes in recent years at extremely low interest rates are staying put. They're not going to move. Now, if you go back to 2008 and 2009, one of the biggest problems we had was the fact that we had a huge amount of inventory, and there was a lot of things that happened from a negative perspective. If you look around the areas, the inventories in the country in general are much lower than they were then. And we didn't have the same problem we had with interest rates at that time. So it's kind of a different area. Again, the nation's overall housing remains limited, and we're going to see that staying put for the time being. New home construction fell again in December, adding to the long-standing inventory problem. Again, it's all about cash flow. So what are experts really looking at in 2023? Well, okay, so home sales will slide. And this year, skyrocketing mortgage rates, rising monthly payments, and loss of buying power have really brought the market to a standstill in most areas of the country. The slowdown in the marketplace really began in February of 2022, when the market began to see the buyers basically falling back out, in some cases falling out of the market because of meeting the demands of the loan officers and the different institutions for getting loans approved to buy to the next step. So according to most experts in the marketplace, sales will likely remain sluggish heading into the spring timeframe before we start picking up in the second part of the year. Mortgage rates are likely to pull back at some time during the year. After increasing to a 20-year high, and back in November, it was at 7.08. Mortgage rates will continue to go down over the next several months. The trend is likely to continue for the further of the year. So that's good news on that side. Experts believe that we'll see relatively a few months later on stabilizing in this marketplace. Now, home prices will level off. Experts see that home prices could fall as much as an average across the board around 4%. And the only certainly is that we won't see double-digit price increases as we've seen in past years on moving. Inventory will remain tight. And one of the biggest causes of skyrocketing prices during the pandemic was the lack of housing supply. And next year, we'll see, next year being this year, improvement, but inventory will continue to remain at fairly low levels. And the other thing is that the equivalent right now is running around 3.3 months supply of existing homes. And I'm going to talk more about that as I get into the report. But to keep in mind, the buyers and sellers could return as 2023 progresses, especially if mortgage rates move lower. And that's what expectations are from the people that are following this very closely. And there's going to be more vulnerability and variability within the markets. The hot was the most common word used to describe the majority of real estate transactions as early as last year. And now that will no longer be the case in 2023, it's now going to be a different mode of operation. It's going to have to be look and see what transpires. Now, the one thing I want to talk about is recession. before. I want to kind of give you a little bit of an update on what's happening with recession before we get into the economic indicators. So consider these points. Number one, recession is still in the picture, considering that we have not felt the real impact of inflation and high interest rates. Keep in mind, everything we saw that took place last year will flow into 2023 for the time being. And there's still a weak pipeline for goods and services. However, and I'll talk about this later, the United States produced 517,000 jobs, while unemployment fell to 3.4%. That's the lowest since 1969. That's amazing.
All right.
And of course, inflation is starting to ease a little bit, but at what pace? And I'll talk about that later too. And the price of goods and services are beginning to decline, but the services levels in that area are rising along with inflation and labor costs. So you can expect the Fed to continue to raise interest rates in March, April, and May, at least 25 basis points. And there are some people in the various Federal Reserves that are recommending it go up to either 0.50 or 0.75 basis points to really get a handle on inflation. And that's what's happening. So on March 1st, the boys get together again and they'll talk about what they want to do to set the new pace. There's also expectations that we could see interest rates raised again in June and possibly July until we can get inflation under control. It's going to take a miracle to get to the 2% target, which we may never get to. Maybe not till maybe 2025. That's how deep this situation is right now. Keep in mind, all these two are moving parts. So there's a lot of moving parts taking place right now, and we'll see where that goes going forward. So now I'd like to take a look at key economic indicators. I'm going to look at gross domestic product, inflation, unemployment at the federal level, and unemployment at the California level. And what we're going to do is the state of California, there's a company called Beacon Economics. They're out of Los Angeles. They're primary, they do a lot of consulting, and they put out the information on the job market for California. Well, unfortunately, there's a lot of restructuring going on with data to make sure the data is accurate for December and January. Therefore, the information for January and February will not be available till March. So we will skip that slide when I get to it. And then, of course, we're going to talk about the price per barrel of oil. So on a global basis, the slowdown dims hopes for labor turnaround in 2023. And what we're seeing here basically is this. If you look at the global GDP, the projection for this year is at 1.8% and following 1.9% next year. And in the United States, 2.9%. We're looking at that right now. And basically, that went out. That's what transpired. So that could be very strong this year. Again, it depends on how things turn around. And then the US GDP is looking to go down next year. That's predicated on some type of recession occurring sometime in the middle of the year. And we'll see what happens. And again, these numbers will change because we're only in February. The CPI index projecting to go out the end of the year at 5.5%. As of last Friday, we're running at 6.4. So we've got a long way to go to get there. And inflation next year will drop down to 3.4%. So it could be until 2025 that we see the 2% target range. Unemployment picture is projected to go up from 3.4 right now to 3.7 by year end. And depending on when the recession, if in fact it takes place and how deep it is, we could see 5% unemployment. The state of California, 4.4% is projected for this year and then going out at 5.4% next year. And again, the range in the oil is still between $80 and $110 a barrel. Our friends in the Middle East and other areas are really targeting oil to be at least $100 a barrel. And we'll see where they are. And I'll give you an idea where we are now. So on a global basis, like I said, the slowdown dims the hope around in the labor market in the global economy. Basically, they're facing a lot of challenges across the board in Europe due to still some impacts of COVID. But in terms of fuel and everything else, it doesn't look good for them as we speak. Chinese imports of integrated circuits fell in 2022. This is the first time since 2004. And basically, they fell by 15% last year. So that's not good. In the Eurozone, improvement is seeing that 2023 is still a challenge, but it's improving. And there was a sharp downturn in energy prices, which is really was driving the slide in the economy there. So it's starting to turn around already, which is good. Now, the Eurozone Central Bank and the Bank of England both last month raised their basis points by 50 points, 0.50. So we saw that happening. Good news in Australia. The Australian currency is now rebounding and it's up 11% in October of 2022. Economists are optimistic that they should see a much better year economically in 2023. Now, domestically, the one thing that's near and dear to everybody's concerns are the housing market. And basically across the board, we're looking at a downturn of about price of 2.5%. Now, for those that you didn't see the article last Saturday, the city of San Francisco announced recently they've lost 56,000 people living in the city have left. And the selling prices now in real estate there has dropped 35%. Now that's just San Francisco and taking a huge hit. So we'll see what that does, but that's just the San Francisco area per se. If you look at, for example, the Federal Open Market Committee, as I said earlier, the target range is for 25 basis points per month over the next 3 to 4 months. We'll see what happens. I know Powell is deciding what he's going to do over the next couple of weeks because March 1 is right around the corner when they have their meeting. The biggest concern we have right now is credit card debt. It jumped 18.5%. And essentially, we're talking about $931 billion in credit card debt, which is huge. And there's some real concerns about that. And the annual rate basically has gone up 20%. So that's from 2022. The oil market is facing a huge production problem in 2024. With a rising price of oil targeted to go to $100 a barrel sometime this year, there's really big concern about that. And we could have a serious problem in 2024 if we don't increase production levels. The mortgage demand in the area, for example, the total more applications last week were down 7.7%. They continue to fall based on affordability index in the marketplace. So looking ahead, let's take a look at inflation. So inflation in January rose 0.5 of a point, and that's more than we expected. So the rate right now for a year ago in January 22, it's running at 6.4%. So we're still too high. And again, we'll see what happens going forward. Here's the other thing. The other shoe, if you will, that just fell was the wholesale price index was up 0.7 of a point in January, and more than expected, fueling a lot of inflationary concerns. Keep in mind, food and gasoline and energy products are not included in the calculation. And if they were, we would probably be on top of a building someplace with inflation. So the trade exports, the good news here is they were up by $453 billion in the month. That's 17% higher than we saw in December, which is very good news. Unfortunately, the trade deficit inched up a little bit to $67 billion, and that's up from the $61 billion we saw in November. Go back a few months ago, we were seeing what was between 80 and 90 billion. So we're at least $30 billion a month better than we've been. So it is getting better. Retail sales, surprise in January, they were up 3%, smashing expectations while inflation continues. So the sales at retailers rose more than expected. Consumers continue to buy either on credit cards or with cash. That hasn't stopped. I mentioned earlier in the job market on a national basis, we see here that we saw jobs were increased by 517,000 jobs. Unemployment had dropped, as I said earlier, 3.4%. The only two elements I want you to look at here is business and professional services has done exceptionally well over the last 2.5 years. Construction is very strong in the month. And if you look again, the real key is leisure and hospitality. That's really key. I mean, that was the biggest hit during the downturn. And California, the data is there from December, so I'm not going to spend any time on that. I'll have that updated as when we meet in March. So if we look at the interest rates, as I said earlier, again, we're going to see the rate hike sometime in March. We'll see what that is. We'll know where that is sometime by mid-March. The 30-year mortgage rate dropped a little bit last month, but as of last Friday, the average rate went out at 6.77%. Now, the manufacturing index, even though manufacturing is doing well, it came out at 47.4, which is below the 50 basis points, which is not good. that indication says that we're either in a recession right now or entering a recession. It's got to be over the 50 basis points level. That's a real key barometer to the economy. Factory orders jumped by 1.8% in December, which is very good news after having a couple of bounces up and down. Small business confidence level ticked up a little bit. It rose to 90 in the month of January. If you go back some time ago, we were over 98. So we still got a long way to go for the confidence level to increase. Consumer confidence again dropped again in January. It dropped down to 107. Still a lot of concerns about what's taking place again with inflation and so forth. So that's happening. Good news on crude oil. So crude oil prices closed late last week, Friday specifically, at $76 a barrel, down from almost $80 a barrel. So moving in the right direction. And hopefully it'll continue to remain in that area. Again, our friends outside the country would like to see it at $100 a barrel. Now let's take a look at the housing market and starts, for example. So high interest rates continue to challenge residential construction. And the housing starts again dropped 4.5% again in an annual pace in January. And this is the fifth straight month we've seen them drop. It's the longest streak of declines since 2009. In the new home sales market, January, the state sales were up 0.4 of a point from December. And if you look at December, of January of 2022, sales were down almost 46%. Now, keep in mind the economic skittishness, especially continuing high inflation, job losses, pricier homes, loans, example, have frozen out of the marketplace. But again, surging mortgage rates have really put a damper on this and caused a lot of people to be in the unaffordability area to buy. So we'll have to see how that improves as we move into the spring. Taking just a quick look at Southern California, in Los Angeles, the median price of the homes on the market at $778,000, they declined by 2.6% in the price. Sales were down 22%, and they were down 38% from January of 2022. Orange County, where Kathy runs the market, the good news is the selling price is $1.194 million, and it increased by 5.5% in January. And sales were down by almost 21% and down almost 36% from January of last year, but they're holding strong in Orange County. And then in San Diego, we saw the median price of $825 decline by almost 3%. Sales were down 18% and 35% from a year ago. Existing home sales, this is the real key here, and that is unexpectedly declined in January, a record of 37% over the year. So this is the 12th straight month of decline for existing home sales. In construction spending, it was up again, which is good. It was up almost 0.4 of a point from December. So we're seeing more money being spent in the construction area. Here's some great news on productivity. You know, that's critical to the economy. Dan Ruckman will tell you that. And the non-business sector, if you will, it increased by 3%, which is excellent in the fourth quarter. And then the increased output was 3.5% in hours worked in productivity. So that's very good for the last quarter. And the next time we'll have information here for the first quarter will probably be sometime in April or May, since they no longer report on a monthly basis. The one area that remained really high since I started doing this program a couple of years ago was the area called what I call company displacements. All right. And it's been up and down. Well, last month is a real high point for this report. So as you know, a lot of activity is taking place around the clock in the country by all vertical markets. And so what I want to do is I want to talk about those firms that had displacements of over 1,000 employees, only those firms. But these are companies you're well aware of. So I'm going to start off with, so Microsoft lost 11,000 employees, Wayfair in the retail sector, 1,750, Capital One, 1,100, Genpact, which is in the global consulting services, 1,000, 3M, 2,500, Lam Research in the Bay, 1,300, Ford of Europe, 3,200, Dow Chemical, 2,000, SAP, big software company, 3,000, Hasbro in the toy industry, 1,000, and watch this, healthcare, Philips Healthcare, 6,000, PayPal, 2,000, Fidelity Investments, FinTech in Florida, 2,600, Dell Computer, 6,600, Boeing, 2,000, Zoom, 1,300, because as we're moving out of the pandemic, their market and their revenue is starting to shrink. And then we see News Corp, 1,250, and then of course Baxter Health, 3,000. And then we have Twilio, which is a San Francisco-based communications company, 1,500. And then Ford, an additional grouping of 3,800. The one thing I want to bring up is KPMG. And it's, you know that I work for one of the big four. I worked for Deloitte for a number of years. And what we saw here is the loss of 700 people. And I'm going to talk more about that later. And that's in the area of consulting services. So think about that in terms of need versus nice to have. Now I'd like to turn, if you will, to mergers and acquisitions. First of all, experts are predicting merger and acquisition activity for 2023 will be substantial, especially in the healthcare industry. Overall activity will increase as economic activity begins to decline as recession fears become more clear and we see flat growth across the nation in all the various vertical markets. So Shell, and you know right now electric vehicles is a hot topic. Good news, Sid, positive. And that is that Shell is buying electric vehicle charging company called Volta for $160 million, $169 million. The idea is to increase their potential in the marketplace. Blue Cross and Blue Shield have been acquired by Elevance Healthcare in Louisiana, and they have about 1.9 million policyholders. So you're seeing some consolidation there. And then we look at Public Storage is buying a bid to buy Life Storage for about $11 billion. And that'll make them the largest one in the country. The top gold mine company called Newmont is offering $17 billion to buy Newcrest. Newcrest basically is an Australian-based company in the mining industry, and this will do to increase their reserves across the board in the mining industry. And then you have CVS continues to be active. They're spending about $10.5 billion to buy a primary healthcare provider called Oakcrest Health. They expand their marketplace. eBay is buying an AI company here. It's called 3PM Shield. The idea is that they're expanding their business in the marketplace by increasing market presence with that particular area, especially in the area of artificial intelligence, which is a key player for them. And then British Petroleum is acquiring Travel Centers of America for $1.3 billion. This is where these opportunities are located on highway sites that complement the existing problem of highway convenience for mobile businesses, etc. Now, there's a lot going on in other significant economic news. So first of all, what we see now is the fact that 3Party filed for bankruptcy. It's another retailer that has been impacted. It's unfortunate, but the company has filed bankruptcy, and we'll see how long. If they're going to go into Chapter 11, and we'll see whether that can be turned around. For those of you who have T-Mobile, that's the second data breach in the last couple of years. Another 37 million accounts have been compromised. And for those, you'll see that going forward. Then crypto lender Genesis filed bankruptcy. And you're seeing more companies in that space filing bankruptcy at this point. So we'll have to wait and see what takes place in the marketplace for this. Then we look at Microsoft is investing $10 billion in it's called ChatGPT, maker of OpenAI. And basically it's an advanced artificial intelligence tool that's really lifted things in the internet since its introduction in November. So you're going to see more types of tools and technology in this space. There's a firm called Elliott Management. They're taking a stake in Salesforce.com. And it's a multi-billion-dollar deal. The terms were not announced, but they're injecting money into Salesforce. Then you have a company called Meta, which is, it's the parent of Facebook. And they plan to sublease 435,000 square feet on Fremont Street in San Francisco. And last year, as you know, they laid off 11,000 people, but the space is going to be, it's not going to be used any longer. So they're moving out of that. Now, Wall Street had a comment a couple of days ago that said basically the biggest round of layoffs since 2008 or to come. The banking industry is preparing now to have layoffs across the board, all the banks, especially those involved in the real estate side of the business. So we'll see that taking place in the future. You've got Bank of America, Wells Fargo, etc. Americans fell behind on car payments last month, and it's the highest level since 2009. And basically, some of these cars are being repossessed, and individuals now are being forced to decide what they're going to do with their money based on making tough decisions. Good news is Boeing is hiring 10,000 people. As you know, they hired 15,000 last year. The good news is they're getting a lot of the kinks worked out with that 737 MAX that was grounded for issues. and it's coming back now strong. So that's good news. And then GM is going to invest $650 million into a lithium mining company in the United States, which we need. Lithium is critical for the whole electric vehicle industry. And basically the mine is somewhere in Nevada. Apple suffered its first quarterly loss in 4 years. We're down $117 billion for the quarter. And again, if you look at that, it's a 5% decline. But the key is the demand for cell phones. And I think if you've got a cell phone and things are tight, you have to decide whether you want to upgrade your cell phone at this time or your watch or you stay pat. And that's what they're seeing taking place right now. Bed Bath & Beyond, which is one of my favorite stores, is closing here in Carlsbad. They're facing bankruptcy. They're in the process of possibly being delisted off of one of the exchanges. And in Canada, basically, they're closing all 54 operations with Bed Bath & Beyond and a group called Bye Bye Baby Stores. So they're in trouble. Not sure whether they'll be able to come out of bankruptcy if they go in. And then we have the used car prices. Again, they were down and they just rose again in the month of January. So used car prices are going up. Now, GM has got a deal now with Global Foundries for a partnership, a long-term partnership to build chips. And this is good news because they're locking in the production scheme because of the lack of chip capability that they've lost from outside the country. And as you know, Global Foundries is a San Francisco, Silicon Valley-based company. And Ford has announced a partnership with a Chinese company partner to build a $2.5 billion factory in Marshall, Michigan, which is good. And it's going to employ and create 2,500 jobs as they continue to invest in electric vehicles for the future. So this is very good news. Now, Walmart announced a couple of weeks ago or last month sometime that they were closing 66 stores around the country. And they've also announced that they're closing 3 technology hubs, one in Austin, Texas, one in Portland, Oregon, and one in Carlsbad, which is here in San Diego. So they're consolidating those areas. And again, the other thing is the United States announced last week that we've taken out another 26 million barrels from the strategic oil reserves. Now, a few years ago, we were up around 714 barrels. We're now dropped down to where it's at 345 million barrels in the reserve. And then finally, the thing I wanted to mention to you is KPMG. So I work for Deloitte, and the Big Four do a lot of work beyond basic accounting, internal and external auditing. They do a lot of consulting services. So KPMG announced that they were laying off 2% of their workforce, slashing jobs in the United States. And basically, it has to do with a prolonged uncertainty about certain parts of the advisory services model. And I would suspect the other 3 CPA firms are all considering doing things along these lines as well. So what I'd like to do now is open it up for questions and answers.
I got